Welcome back. I'm Michael Bull, and this is the Commercial Real Estate Show. Today we're talking retail real estate. We're looking at 2017 and what we might see. Please welcome my next guest. It's Lea Overby. She's Director of Structured Finance Research at Morningstar Credit Ratings. Lea, thanks for joining us.
Oh, my pleasure. Thank you for having me on the show, Michael.
Well, thank you for joining us. And I saw an article that you had written about a lot of these store closures, these big box stores closures. If you will, recap a little bit of what you're seeing on announced closures today.
Well, we are just finishing up with holiday season, and as expected, we are starting to see some of the retailers announce store closures. I think the ones that have hit the most press news is the Macy's announcement of 100 store closures, as well as the Sears announcement with another 42 added to their pipeline of store closures.
Yeah, and what does this mean for some of these major malls to have these kind of closures, and then also some of the REITs that own them?
This is where it gets really interesting. The timing for our call is particularly relevant, as within the CMBS universe, we just had our first large loan with take a significant loss within post-crisis issuance. So just this past week, we got news of the Hudson Valley Mall resolution, which is in upstate New York. It took a loss of more than 85% after it lost its Macy's and its Sears. So one of the things that we're seeing is that once these anchor tenants leave, the malls tend to deteriorate very, very, very quickly. It's certainly a case of haves and have-nots, because some of the more well-capitalized REITs do a nice job of re-tenanting the space and pulling in new anchors or new concepts, while some of the mall owners who may not have as deep of pockets really, really struggle when some of these anchors leave.
Yeah, and that makes sense. So what are you seeing on some of the re-tenanting by some of these REITs?
It's a little bit all over the place, especially in more high-end malls. We see a lot of entertainment concepts coming in, anything from bowling alleys to arcades back to the 1980s, also children's play areas, new restaurant concepts, and then also there's a handful of kind of newer to come to market retailers which will take a sizable portion of the space. For instance, H&M or Zara, Forever 21 has done a decent amount of large box occupations. So that's more or less what we're seeing.
Right, yeah, and a lot of those you mentioned in the beginning are kind of based on experience, and that's really helping the shopping malls and shopping centers today to get that experience there. And you mentioned CMBS, so this has got to have some impact on CMBS market to have all these closures. What do you see?
Again, it's kind of hit or miss. Mm-hmm. Within the CMBS universe, there are certainly deals out there which have exposure to some of the weaker malls across the country. I guess mid-last year, the CMBS investor community really, really pulled back from investing in these deals in particular because of concerns of outsized losses. You know, other deals without the exposure to the Class B malls are doing okay.
So what do you see for upcoming maturities in CMBS, and of that, how much that might have some trouble?
Well, we've talked for years about this wall of maturities. Most CMBS loans tend to be 10 years. So right now in 2017, we are seeing the loans underwritten right before the credit crisis in 2007 come to maturity. At issuance, we had close to $250 billion done in 2007. However, over the following 10 years, this pipeline has reduced considerably. So now that we're starting into 2017 as these loans come due, right now we've only got, call it $80 billion left to work through. Part of this reduction is because some of the weaker loans clearly didn't make it through the crisis. They defaulted then at that time. And at this point, a lot of the stronger loans have taken advantage of low interest rates and refinanced themselves out. So what we're left with, this $80 billion, is very much the moderate to weaker set of loans that need to find refinancing right now.
Okay.
So of this, Of the 80 billion, call it 23 billion is retail, and we're expecting about 40% of that's going to refinance without a problem, which means considerably not. Means 60% is not.
Right. So we have roughly 27 billion of problem CMBS loans maturing?
Yeah,
roughly.
That's about right.
Yeah. Well, I guess that's some people look at that as possible opportunities out there, and some people won't. One of the things I think is impacting financing is the DoddFrank regulations, and Trump's in there saying now he's going to reduce regulations, including DoddFrank. What do you expect, and what do you expect to be the impact?
It's really hard to say without a lot more clarity in terms of specifically what aspects of Dodd-Frank might end up getting repealed. The consensus is within the CMBS community is that the areas that the new administration will target within Dodd-Frank are probably more geared towards the Volcker rule rather than the risk retention part of the legislation. So the Volcker rule has reduced liquidity in that it makes it more difficult for broker-dealers to hold bonds for position. And this certainly affects both CMBS and the broader markets overall. The risk retention aspect of Dodd-Frank seems to be a little bit more ingrained and is likely going to be in place for sure through 2017, which is when we have this wall of maturities coming due.
Interesting. Okay. Well, what tips would you leave with our viewers and listeners related to retail and maybe upcoming maturities or opportunities or things to watch out for?
I guess over the last handful of years, we always project out what's coming up for maturity, what may have problems, what may not. And always I have been pleasantly surprised that the markets have found solutions. So, we talk about the sizable portion of the retail space which may end up having difficulty refinancing. And I do believe that this is more of an opportunity than a threat. The amount of capital that has been raised for additional financing, mezz financing, or bridge financing is sizable. So I do believe that while it's easy to be very doom and gloom about what's going on in the retail sector, especially regarding the wall of maturities, it's also important to remember that with the right capital sources, these do represent good buying opportunities potentially.
Yeah, I like the good news slant on that, Leah. So what do you think about Trump getting in there? If he's going to reduce corporate tax rates, if he's going to reduce personal tax rates, does that mean there's more money to spend? And us Americans, we like to spend, right? So is that going to help retail?
That is for sure. It's very difficult at this point to fully flesh out what the ramifications of all of the policy announcements may be. So on one hand, increased consumer spending may certainly benefit the retail sector. The counter-argument to that, though, is that one of the issues that retailers are having right now is the increase in Internet sales.
Yeah.
So even if we do have increased consumer spending, it is not clear that that spending will be done in malls. So that's one of the issues that's out there. Another issue is that some of the policy recommendations that are coming out of the new administration involve tax policy and trade policy. And both of these may have negative implications for the import costs, for instance, or the way properties are carried on books. So there's also noise in terms of these things that will need to get played out over the next year.
Yeah, you're right. There's some interesting times ahead of us. Leah, thanks for joining us today. We appreciate you being on the show.
Absolutely. My pleasure. Thank you so much.
Well, stay tuned. We'll have more on retail and retail real estate, including more projections for 2017. I'm Michael Bull. This is the Commercial Real Estate Show. Stay with us. Hey there, thanks for checking out the Commercial Real Estate Show. Don't miss a video of special interest to you. Be sure to subscribe below. And if you appreciate the videos, be sure and thank our sponsors. There's a link to more information about them in the description. For more videos, podcasts, and articles, check out CREshow.com.